Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. This video presents a direct informational narration of the source document. Today, we're doing a deep dive into the August 11 market briefing, unpacking the raw data to see what's really moving the markets. From macroeconomic tremors to sudden crypto pivots, we are going to break down exactly what you need to know.
Here is our agenda for today. We've got 6 key areas to cover. We'll start with a macro and geopolitical overview, then dive into CPI and market technicals, followed by cloud and hardware earnings. After that, we'll hit aerospace and AI semiconductors, big tech and crypto pivots, and finally, wrap up with retail and e-commerce updates. Let's jump right in. Section 1. Macro and geopolitical overview, covering pre-CPI market shifts and Middle East tensions.
Ahead of the crucial Consumer Price Index, or CPI, release, which measures overall inflation, we've seen a really heavy wait-and-see sentiment. This cautious vibe actually caused major stock indices to slip as funds rotated out of highly valued tech and into safer, defensive, and cyclical sectors. And, adding fuel to this cautious fire is the highly complex and volatile geopolitical situation in the Middle East. We're seeing a stark contrast in maritime conflicts right now. Over in the Gulf of Oman, a U.S. strike on a Panama-flagged, Iran-linked ship ended with all 17 crew members confirmed safe, despite the vessel catching fire. But then, on the exact same day in the Red Sea, a Houthi attack on a Saudi ship transiting the Bab el-Mandeb Strait tragically resulted in at least 3 crew fatalities. Amidst all of this chaos, the Pakistani defense minister claimed in an interview that a U.S.-Iran agreement was close, which caused oil prices to briefly drop. But he almost immediately walked that back, stating the strait wouldn't reopen until certain conditions were met. And boom, oil volatility spiked right back up.
Moving on to Section 2, CPI and market technicals, focusing on JP Morgan scenarios and Nomura CTA triggers. Looking at JP Morgan's trading desk, they projected that Wednesday's inflation data could cause the S&P 500 to swing up or down by as much as 2%. They modeled 5 scenarios, but the highest probability one sees core inflation landing at a tame 0.2%, which they predict would drive a mild S&P 500 gain of somewhere between 0.25 and 0.75%.
Here's how this plays out for the S&P 500 technically. We currently have a massive ceiling of upside resistance at 7,900.3, thanks to heavy call option accumulation. If we break that, we could see a short squeeze, pushing prices even higher. Our current index level sits at roughly 7728.0. Now, on the downside, if we drop to 7600.0, those algorithmic CTA models we just talked about might automatically trigger short-term sell-offs. And the medium-term CTA model sell trigger is lurking roughly 4% below our current level, down at 7430.0. Dropping below this would activate heavy medium-term selling, though we do currently have a comfortable 300-point buffer.
This cautious technical setup ties into broader global dynamics, especially with what's happening with the Japanese yen. We saw a coordinated FX intervention back in late July, where they were essentially selling US dollars and buying yen to prop up their currency. But it had a very limited effect. It essentially failed, and the yen is already approaching that critical 160 level again. It turns out that for any meaningful structural impact, Japan actually needs a real interest rate hike, which structurally requires US approval.
Section 3 is cloud and hardware earnings, looking at Eli Lilly, Datadog, and Supermicro Q2 results. Let's talk about Eli Lilly first. They had an absolute monster of a quarter, reporting revenue of $10.11 billion. That is a massive 109% year-over-year growth, alongside some really strong fiscal 2027 guidance. Meanwhile, Datadog delivered Q2 revenue that completely doubled year-over-year. What's really interesting here is Datadog's recent inclusion in the NASDAQ 100 index, which forces index funds to buy in, adding massive structural momentum to the stock. But the sheer scale of Datadog's pipeline is the real story here. As of June 30th, they were sitting on a massive $14 billion order backlog. And get this, that $14 billion figure doesn't even include an additional $25 billion from new clients that were added just in July. Moving over to Supermicro, or SMCI, their Q4 was definitely a mixed bag. Revenue hit $11 billion. Now, that's a 93% jump year over year, but actually missed Wall Street's $11.26 billion estimate. However, they absolutely crushed their adjusted EPS, coming in at $1.70, which is up 315% year over year, and beat the $1.59 estimate. Gross margin came in at 17.5%, up 800 basis points. But the real takeaway? Check out their Q1 guidance. It's incredibly strong. They're projecting Q1 revenue between $14.5 billion and $15.5 billion, which easily beats the $12 billion estimate. And their Q1 EPS guidance is set at $1.01 to $1.10, beating the 0.74 estimate. They essentially manage expectations by hinting at preliminary weakness in July, only to blow past estimates now. And much like we saw with Datadog, Supermicro is sitting on a staggering order backlog, $60 billion to be exact. This incredible volume of future business is the massive engine driving investor optimism right now. Section 4 brings us to aerospace and AI semiconductors, featuring Rocket Lab and Micron updates. Starting with Rocket Lab, they reported record Q2 revenue of $234.1 million. However, they missed EPS estimates and actually lowered their Q3 margin guidance to between 29% and 31%. This pressure is largely tied to delay risks surrounding the timeline for their highly anticipated Neutron rockets made in flight. Yet again, though, the backlog metric is front and center. Rocket Lab boasts a $2.36 billion backlog. The critical question for investors now is whether Rocket Lab can actually convert this massive backlog into rapid, stable revenue over the coming quarters, while dealing with those rocket delays. Switching over to AI semiconductors, we've got a really significant update from Micron. Executive leadership explicitly stated that AI-driven demand continues to push intense supply constraints. Because capacity expansion is trailing so far behind explosive demand, these constraints are expected to persist well beyond 2027. Think about that. 2027 is literally an eternity in the tech world. Client demand signals have only strengthened since their last earnings report, making the supply-demand gap tighter by the day. Let's move right into Section 5, Big Tech and Crypto Pivots. We are seeing some fascinating structural shifts happening here. One of the most intriguing developments is a major cryptocurrency mining company pivoting hard to secure a massive long-term agreement to provide power for AI data centers. Looking at the specific deal terms between IoT and NOPAC, we are talking about a base value of $9.1 billion over a 20-year duration. With optional extensions, the maximum value could reach a staggering $16.1 billion, with IoT supplying 191 megawatts of power output. This is a monumental strategic pivot from crypto mining to AI. But despite this massive deal, the stock experienced a classic sell-the-news reaction, dumping a 20% pre-market gain right at the opening bell. Also in this sector, Google's stock took a hit today, which is kind of surprising considering Berkshire Hathaway is sitting on a roughly 22% unrealized gain on the stock at an average cost basis of around $280. Meanwhile, the rare earth sector has completely come back to life, rebounding over 48% from its lows. This surge follows an announcement where the U.S. government committed over $3 billion into critical minerals and battery materials, right after sitting down with 200 industry executives. Finally, Section 6, Retail and E-commerce updates, where we are seeing a really stark contrast right now between struggling traditional retail apparel and booming Southeast Asian e-commerce. First, the struggles in retail. A major Swiss shoe brand saw its stock plummet over 20% to intraday lows after its Q2 earnings release. Net sales hit 850 million Swiss francs, which missed the 878 million estimate. Now, while adjusted EPS came in at 0.35 Swiss francs, slightly beating the 0.34 estimate, the company still lowered its full-year margin guidance. This massive drop is being driven by slowing global wholesale momentum, rising operational costs, stubbornly high inventory, and falling core customer retention. And Nike hasn't fared much better. The stock has completely flatlined over the last 4 months, capping off 5 consecutive years of overall decline. Between ongoing stock stagnation and looming tariff risks, retail investors have almost entirely abandoned these traditional apparel stocks right now. Conversely, C Limited, or SE, is absolutely booming. They just reported a massive 48% year-over-year revenue increase, bringing them to $7.8 billion, and their net income hit $458 million, which is a 10.6% year-over-year jump. Those incredible Q2 metrics are exactly what drove a 60% stock rebound from its absolute bottom.